Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Stuart Fiertz, President and Director of Research at Cheyne Capital. Welcome, Stuart.
Thank you, Alex.
So I thought today one of the best places to start, given your interest in markets, is to sort of help us unpack the central bank influence that's leading to some dislocations and distortions in markets. Maybe if you could sort of kick us off in what you're seeing there.
Yeah, thank you, Alex. I think that what we see is clearly a tremendous impact on liquidity in the market that's driving down interest rates to new lows, and in particular, we're seeing equity markets recover most of their sell-off. But within that those two bookends, if you will, there are segments of the market that have not recovered back to their back to their pre-March highs, and that's where we find quite a bit of interest. With being a little bit more specific, Alex, you can see that generally speaking, private equity sponsored companies are excluded from having access to these lending facilities. That makes it interesting to invest in some of those markets. And then you also have, in Europe, we have a lack of a TALF type program to support the asset-backed markets. And so we see some of the real estate-backed bonds really lagging that recovery and still providing quite a bit of interest. And then I would say that even within the equity markets, one has to look a little bit at the composition of the rally. In the U.S., there's particularly strong leadership from the tech companies that are perceived to be winners in this kind of environment. And here in Europe, we have tech makes up about 10% of the market cap of the U.S. And as a consequence, you see European equity markets are still down 26% year to date.
Mm-hmm. Look, you've really raised an interesting point, which is sort of the divergence in markets, right? In terms of particularly in the equity markets, and it feels like there seems to be a bit of a different sort of divergence between Wall Street as a whole and Main Street. Are you seeing that also in Europe? And what does that mean?
Well, we are seeing perhaps a little bit less of that than in the U.S. and that we don't have as many perceived winners, or the winners have not yet been recognized in the same way on the equity side. I think there's perhaps a little bit more realism here in Europe that this crisis response, while absolutely necessary, the lessons from 08-09 were learned to immediately open up the floodgates of both monetary and fiscal expansion. But there is a recognition that companies will come out of this crisis with substantially more debt on their balance sheet and with a likelihood of much lower earnings or a lengthy recovery back to peak earnings. And so there is a question as to which companies will survive in this environment. We know we're somewhat surprised that cruise ship bookings in the U.S. are ahead of where they were 12 months ago. It seems to us that either enforced changes in consumer behavior with social distancing and so forth, or consumer reluctance to engage in the same activities as before is going to lead to some changes that are not all beneficial to companies.
It's funny, when you think about the support that's come from financial, the monetary policy and fiscal policy, but is it really enough to sort of really address some of the broader Main Street issues. Obviously you can talk about behaviors of people, and there is some, I guess you could say it's positive behavior around cruise ships, but I guess then if you think more locally to Australia, there's still a lot of hesitation. So, firstly, I guess there's two parts to this question. One is, have the central banks and the governments done enough to try and help restore the economy? And then what does that mean for sort of broader investment markets too?
Well, I think you're right to pose that question, Alex. In the first phase of the response, it was accepted and that we needed this funding to address issues of liquidity. And as the crisis or the lockdown continues, as we see the economic life being strangled out, the question really moves to one of solvency. And here there is I think, a lack of recognition of that shift from liquidity to solvency. You're beginning to see governments talk about the need to either inject equity rather than debt, or indeed to convert loans into equity. The normal channels of doing that, Chapter 11 or voluntary schemes of arrangement here in Europe, are that system is going to get clogged up, and I worry that it is not going to be a smooth transition. What it means for the markets is that those investors that can be selective and invest in companies that won't come out of this over leveraged, you can generate some pretty attractive yields. Or alternatively, you can go the other side and invest with those managers that are able to navigate through a restructuring process, whether it's a Chapter 11 in the U.S. or through what would generally be a voluntary scheme of arrangement here in Europe.
Is this likely that we'll end up with a whole range of zombie companies that take quite a while for this process to work its way through? You sort of alluded to maybe the difficulties in going through this reorganization. Is that likely to be the case in terms of investing in this sector? That there's a real challenge to identify companies that can survive, or is it more clear cut than that?
No, I think it is. It takes some skill and selectivity to back the winners. I think your question about the zombie companies is a good one. The European regulator had instituted a shift to IFRS 9, which was designed to force banks to recognize the economic situation of a company or of a loan rather than just waiting until the company defaulted. And that the old regime was perfectly set up for an approach to extend and pretend and keep a company from defaulting just as long as they paid their interest. Today, with the impact of the lockdown, I think that the stage is set for a shakeout, that the zombie companies are going to hit the wall because they need liquidity to come out of this shutdown. They have received some financing, perhaps, to pay wages in the interim, but they need liquidity to get going again, and that liquidity is not going to be forthcoming from banks or from the market without addressing their balance sheets. So actually, I think this is going to shake it out. I think governments and central banks are going to have to manage the pace of that shakeout, but I think it's going to happen over the next couple of years. You won't have the same kind of 10-year lag that we saw in particularly in Europe since the GFC.
Yeah, that was exactly the sort of the question I was trying to get at, which is sort of the lag that's there. Are we sort of going to be papering over some of these really big fundamental problems that have led to some zombie companies, and hopefully we get back to sort of this dynamic, which is a clearing out of some of these businesses that have been perpetually losing money. And I guess the other question is, for how much longer can central banks continue to keep propping up certain parts of the markets. Obviously, their programs are pretty wide, but they do have limits as to how far they go. And not every sector can be benefited. Maybe if you could sort of give us a little bit of an overview of sort of where you're seeing more the dislocations, where central banks can play and help to support particular sectors versus where they can't.
Yeah, I think there's a point to be made that in cases central banks choose not to, but they could, and I say that because. Post the GFC, the European central banks, whether it's the ECB or the Bank of England, chose not to support the asset-backed markets. In fact, they took the biggest book they could find and they really smashed that part of the market. And this stands in real contrast to the U.S., where you saw in the GFC the very successful TALF program, and now you see TALF 2, which is being rolled out in the U.S. as we speak. There's a few tweaks to it, and you don't see a parallel to that in Europe. So more could happen for us as investors. That's in some ways fortuitous because it gives us a chance to invest in securities that haven't been driven back up again by that liquidity. The other point I think I made earlier, but it's worth expanding, is that central banks and governments have chosen not to support companies owned by private equity firms. And that's partly a political decision. Partly it's based on the belief that private equity company managers have great amounts of untapped resources that they could bring to bear, and they ignore the fact that oftentimes these companies are financed out of a specific fund that may no longer have any excess dry powder to support those businesses. So we think there's a particular opportunity to provide leverage to companies that are private equity owned that need more liquidity, and here we can take advantage of the poor covenants that were embedded in both bonds and loans pre this crisis. That opens up the opportunity to provide super senior rescue financing. Effectively, we're priming the existing lenders, whether they're banks, holders of loans, or bondholders, and ending up in a senior secured position with quite an attractive convex position where you make a very good return, maybe even a better return if things return to normal faster than you've assumed. And then on the other side of the spectrum, if things do get worse, if there's a second wave of the virus that requires a lockdown, if the economic recovery is more extended than you've assumed, then you're in a good position to convert your debt position into a controlling equity position. And as long as you enter into the business at a low enough targeted multiple of EBITDA, then you can actually make more money in that kind of a downside scenario. So you end up with a truly convex exposure.
Mm-hmm. And is there particular types of businesses that you're looking at in that private equity space, or is that across all sectors?
I think that the easy money, if you will, has been made in, if I may put it, in the more obvious sectors. So, food retailing and cable, for example, a business that has been thriving under these circumstances, particularly the food delivery services. Supermarkets have remained open. With it, and you've seen loans and bonds recover back to their pre-crisis levels or pretty close to it. But when you start to look at more economically sensitive sectors, you can find interesting opportunities both in the traditional manufacturing sector, consumer products areas, but also in the more exposed sectors like transportation, whether it's airlines or indeed cruise ships that I mentioned earlier. So one has to be selective. One has to look and see which companies have the best are best positioned. The ones that have the airlines that have unencumbered aircraft are much more interesting than those that are operating under a leasing model and have no further collateral to offer. So we've seen opportunities across the board. One of our favorite exposures is a UK owner and operator of leisure centers, very well positioned for a environment of lower economic growth or even, indeed a recession, and a company that is likely to benefit from ongoing travel restrictions and a trend towards staycations. This is a business that operated well during the GFC, was operating at about 98% capacity pre the spread of the pandemic. The equity sponsor has got £750 million sitting beneath us as one of the largest real estate owners in the world, and you can buy that position with a view of generating returns in the around 8% on the downside and 12-15% on the upside, and we think that represents very attractive risk reward opportunity.
Mm-hmm. This is a great place to sort of transition to real estate more broadly, right? It's one of those areas that has really copped a lot of heat, particularly the commercial real estate in Australia. It's under pressure like it is around the world, and then even on some of the student housing and even sort of the other build to rent style properties, particularly in Australia. There's now more and more pressure from governments to cut rents. What are you seeing in that sort of spectrum of real estate?
Well, it's as you say, it's a really interesting space because you've got governments encouraging tenants to not pay their rent, or landlords to accept rent waivers, and that has a real knock-on impact as to the financing that the landlord has used. And we think there are a couple of shoes still to drop on that side, both in the U.S. and in Europe. In the March-April rent cycle, you had sort of rent receipts of around, somewhere in the 82-85% level, and between those rent receipts and rent reserves, you had most real estate loans were kept current. We're a bit more pessimistic about the June-July rent cycle, where you will see the full impact of what's generally going to be a full 3 months of lockdown. So we think there's quite a number of defaults that are going to rumble through the CMBS market and lead to downgrades and probably some more selling pressure from investors that can't hold the paper any longer. We think that gives you opportunity. We think there's opportunities today to position yourself to profit from that. If you're investing in, say, the senior debt of a hotel group and your look-through LTV, so multiply your discounted price to par times the LTV, and you end up with a look-through LTV at which you'd be happy to own that asset. And if you choose assets with good, solid equity sponsors, deep-pocketed equity sponsors that are pretty unlikely to want to lose those assets at that kind of price, then you can be comfortable that you're going to earn that yield and potentially quite a bit more if that debt is refinanced more quickly, or if the bonds loans end up trading up. So one can't throw out every sector. We're particularly concerned, however, with the retail sector, where we estimate, and we may be a bit more conservative than some, but we estimate that retailers need to cut their rent bill by some 50%. Now, the knock-on impact of that, of asking for a rent cut in exchange for a participation in operating profits or a revenue share, it really changes the very nature of what retail property is and makes it a much harder asset to finance going forward. the asset then becomes neither a traditional real estate asset with a fixed rent and perhaps escalators, and it becomes not exposed. It doesn't transform into full exposure to the retailer itself. It becomes this hybrid of part fixed rate, part floating rate that doesn't have a natural home, and we think that's going to be difficult for the market to digest.
Well, is that likely to change the types of shopping centres that we'll see in the future then?
Well, I think the assets are already sitting there, and it's going to be in the interest of lenders who will end up with control of these assets in general to have them be used. So I don't think it means that those centers are going to change overnight. It may mean that that the landlords spend more time underwriting and choosing their tenants. They have to make bets more on the prospects of those retailers, longer term prospects of those retailers with it. So I think you may see the emergence of maybe better capitalized retailers being the tenants of choice on that side. I think our perspective is that shopping centers will probably do better than the high street, but one needs to be quite sober in assessing their outlook.
Mm-hmm. But maybe if we switch to sort of the commercial real estate space as well, how do you think about sort of the return to utilization of that part of the market? With a potential for significant change in social behaviour and their preference to work in these sorts of environments. Is there likely to be still a lot more significant pressure in that area too?
Well, that is the big question as to what the occupancy will be going forward. I think in Europe we're in a favorable position where there wasn't an oversupply going into this crisis. And we've seen a number of large projects either delayed or mothballed. For example, the Leadenhall project in London was going to be 1 million square feet. That's been put on ice for the time being, and that means that any space that there's today isn't going to face a glut of supply going forward with that. I think that one of the big challenges that the towers have today in advance of a vaccine, or at least a reliable treatment, is the need to end up with social spacing and elevators that already were frustrating pre-crisis. If you can imagine an elevator with only 1, 2, or 3 people in it compared to the 10 or 12 that are crammed in there today. So there's some challenges for the higher rise buildings they have to get over. I think that demand growth will definitely be slower than expected. The flip side of this is that a number of users had switched to hot desking, and it's not clear that individuals will want to go back to hot desking because you won't know who was sitting there. You won't know who's using the phone. Has that desk been disinfected since you were there last, and so forth. So we'll have to see a little bit how demand shakes out going forward.
Mm-hmm. What about the other space which has been quite hot in the Australian market is student housing, and sort of how that plays out. Have you got any views in terms of that part of the market?
Yeah, I think that in Europe, student housing, when I say Europe, let's say Europe ex the UK, student housing was just beginning to come into existence as a segment of the market. If you look at a city like Bologna in Italy, a number of top universities there, and if I recall the numbers, there was something like student housing provision for only on the order of 1% of the student population in the entire city. So I think there's room for any of the projects that are currently underway to be utilized. I don't think the need for low-cost housing or affordable housing has gone away in any of these cities. So I think there's still going to be demand for student housing as the need for affordable housing competes with those students. Mm-hmm. With it. We have a challenge here in the UK, and maybe one of the reasons why we're still taking our time to impose a quarantine kind of processes that is UK universities are heavily reliant on foreign students for their fundamental funding model, and that remains one of the biggest challenges. I think today one wants to certainly stay with the stronger operators, with the more attractive stock, potentially even looking at stock that could be converted to co-living or micro-living type environment if necessary.
Mm-hmm. One of the things that I think we probably need to talk to is in the real estate space, particularly, is that historically these rents have had inflation, built into them, or some sort of a price, increase. Are these assets going to be facing more of a struggle if we start to move into deflationary environment, or maybe best case some sort of a stagflationary environment? How do you think about these types of assets and credit in that environment?
Yeah, I think, Alex, that's a good question. The trend we think will be towards shorter leases, and that whether they're retailers or companies are going to want to be locked in for a shorter period of time, that the landlords will bear more of the risk of rents going down, as opposed to being able to count on 30-year leases upward only, and that will make real estate harder for institutions to own that as a kind of an upward only or a convex asset in and of itself. Mm-hmm. I think that there is a real risk of stagflation going forward that we need to think about, and I think to the extent that you can gain exposure to explicitly inflation-linked leases, those will be a much better bet than going with open market rent review leases. And I think the risk for stagflation is particularly high here in the UK, but across the world. I mean, the assumption is that we're faced with an environment of deflation, with job losses, with a drop in consumer demand, with plenty of excess capacity on the production side. But one can't deny that there's been a historically aggressive combination of monetary and fiscal expansion. You've got a Fed balance sheet that is heading towards $10 trillion. That's nearly 5 times where it was at the end of the GFC. And you have a tremendous shock of negative productivity growth, of broken supply chains, of mandatory or socially required distancing of individuals, and a real loss of labor mobility. Of course, here in the UK, we're going to feel that the most, as we're currently negotiating, or maybe not so negotiating, but we should be negotiating Brexit, and that's going to lead to a real increase in costs that may not be offset by oil prices. We could end up with a return to 1970s style stagflation. So I like on the lease side, I like to be in inflation-linked leases. I like to be on the credit side in either short-dated credit or indeed in floating rate strategies where you're positioned to be protected if inflation does indeed pick up again.
One of the areas, I guess, you sort of touched on there around sort of being protected as such, and there seems to be like there's still going to be quite a lot of volatility as this whole thing shakes out, is, maybe, do investors need to start thinking about the CDS space, as a way to sort of address their risk, or maybe, try to smooth out some of this volatility? How do you look at that?
Yeah, I think that what we've seen with credit default swaps is that they reflect credit spreads widely, and they'll move in tandem with that. Credit default swaps could have some interest, particularly in Australia, where you've seen the risk of early redemptions of pension pots come to the fore. It's been talked about elsewhere, but you've seen it in practice. And if there is a second wave and another bout, and if the central banks have perhaps spent their balance sheet on supporting credit, it might be interesting to switch out of cash bonds in advance of that and hold your credit exposure synthetically. That way you would have a pot of cash and still be able to harvest the generous risk premium on investment grade credit. Just as a highlight of that, investment grade credit in Europe today discounts a cumulative default rate over the next 7 years over the next 5 years, of just 7%. And the historic average for the last 50 years has been just 90 basis points. And the worst since 1970 has been 2.3%. Indeed, even the Great Depression, cumulative default rates were only about half of that number, around 4.3%. So you're getting paid a tremendous amount to take investment grade credit risk. We think that owning it in CDS format allows you to hold liquid cash on one side, and also lets you avoid exposure to long-dated interest rates, which I view as all risk and no return.
Mm-hmm. All right, that's a fantastic place to leave it. Thank you very much for your time today, Stuart.
Alex, thank you very much for this lovely chat.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.